Hi, everyone. So, welcome to the live stream today. It's always a pleasure coming your way as we continue with our discussion towards the ICA November 2021 examination. It's always a pleasure coming and joining you on the live stream. I see some of you coming up. You are welcome to the stream. Today, we're focusing on another critical accounting standard in our studies, and that is going to be IAS 37 provisions, contingent liabilities, and contingent assets. I see some of you guys jumping on Facebook as well as on YouTube. You are welcome. Give us a thumbs up on the video when you join. It helps us a lot to push the video so we can reach as many students as possible. And also remember to put in the comment section or the chat box any questions you have for me and the things that you would want me to share my thought on as we continue with our discussion for the day. So let me know where are you watching from, what questions do you have for me real quick. Real quick in that case. Okay, we are getting some thumbs up from Facebook as well as on YouTube. You are welcome to the live stream today. Yesterday we discussed in detail IAS 40, and I was so much excited about the questions that I got from you guys relating to the various clarifications that you need to understand about revaluation of assets, treatment of all these things, and how you can actually bump yourself up in order for you to understand it very well. And so we want to just keep it like that today and continue with the discussion like that today as we get into the discussion. I see some comments coming in. Let's see if we can look at them. Laura Machaka said, good evening. Good evening, Laura. You joined us yesterday. Welcome again today. Hope that you're doing well. Augustine A. Barton. Yeah, Augustine. Hello. I hope that you're doing well, Augustine. If you join the stream, let me know in the comment section any questions you have for me, what you would want me to share my thought on, and also most importantly, you can share the video. Let us reach as many students as possible watching the live stream in that case. So let's go straight up into our discussion for the day and let's see what we can do in that case. So today we are focusing on IAS 37 provisions, contingent liabilities, and contingent assets. This is one of the basic standards that you must know about when it comes to dealing with the accounting standards. Like I said, this standard it has some relationship has some relationship with IAS 16, that is property, plant, and equipment, and it's very important for you to understand the treatment on that case. So before I go into my question for the day, let's quickly run through the basic principles that we need to understand when it comes to dealing with provisions, contingent liabilities, and contingent assets. And you can see this diagram right here on my screen, which is going to provide us with a summary of the things that we need to understand when it comes to provisions, contingent liabilities, and contingent assets. Remember that you can watch the full lecture of this on the YouTube channel. Just check the playlist accounting standard lectures and you'll get a full lecture. But what I want to do here is to give you like a crash course understanding on the standard and exactly what it is that you need to do in order for you to increase your chances of passing the exams. So let's go straight up into the discussion. Now, in looking at IAS 37 provisions, contingent liabilities, contingent assets, the first question we need to ask ourselves is, what is provision, or what are provisions, and then what is a liability? In a simple language, we say that provisions are liabilities of uncertain amount and timing. Provisions are liabilities of uncertain amount and timing, meaning that we owe some money, but then we don't know how much we owe, neither do we know when we're going to be making the payment. So it is called provision. Liability, on the other hand, as per the conceptual framework, it's defined as a present obligation as a result of past events. A present obligation as a result of past events. So that is the basic idea we need to understand about liability, and the basic idea we need to understand about provisions. But a critical question we ask ourselves is, At what point can an entity recognize provision? So we say that when it comes to provisions, the ROT recognition criteria takes place. That is, the amount should be reliably measured. Okay, reliably measured. The amount or the cost should be reliably measured, and then there has to be present obligation, and that obligation can be legal or it can be constructural, and then the settlement of which will result into a transfer of economic benefit embodying the entity. So traditionally, when we talk about the recognition criteria of provisions, we said rot. So if it is rotten, you provide for it literally in that case. So the amount should be reliably measured. There has to be present obligation, then certainly transfer of future economic benefit. Note that the key thing we need to be on the lookout for when it comes to provisions is that there should be a present obligation. If there is no present obligation, then the entity cannot recognize provisions in its books or disclose about it in its books in that case. When it comes to the reliable measurement of the provisions, there are various methods that can be used. We can use what is called the best estimate approach. We can use what is called the expected value EV, and then we can use the discounted cash flow approach, where we look at the future value of the provision that we are, or the debt we are likely to pay, and then we discount it into present term. This is usually going to be the case if we are going to be sharing our thought, especially on IAS 16, property, plant, and equipment. Then when it comes to the obligations, the obligation should also be legal, meaning that it should be an obligation arising because the company has signed a contract, or it could be contractive, meaning that, or constructural, meaning that it is based on the past events of the entity, a publication on the entity's website, or better still, the past behavior of the entity. So basically, when it comes to provisions also, this is what we need to understand. Like I mentioned, the recognition criteria is very critical in that case. Then we ask ourselves, what are some of the types of provisions that can come in, or what events can result into the entity making provision or not making provision? So let's look at a number of them in my chart here real quick. Warranties. Warranties meet the recognition criteria for provisions because so we provide for warranties. Now, warranties are simply an assurance that an entity gives to its customers to replace goods that have been bought or services rendered should there be any fault within a given period of time. So immediately the entity sells the goods or renders the service, the entity would provide for warranties. So warranties meet the recognition criteria, so we provide for it. Then the second thing is the issue about decommissioning cost. Decommissioning cost, it's also more or less like EC, environmental cost, not electoral commission, environmental cost. And that also meets the recognition criteria of present obligation, because this could be because of a contract that the entity has signed with the government, or maybe the past behavior of the entity. All these can result into decommissioning costs. So decommissioning cost also meets the recognition criteria, hence we provide for it. This is where we're going to be discounting it into present terms, and we get the value there. Future operating cost. It doesn't meet the recognition criteria, so we don't provide for future operating cost. Onerous contract, it meets the recognition criteria, so we provide for it. Onerous contracts are simply contracts that an entity undertakes, once in a blue moon contract an entity undertakes, which results into a loss. Okay, so such contracts, according to the standards, the entity can provide for it. Then the last thing is restructuring cost. When it comes to restructuring cost, restructuring has to do with a change in the operations or structure of the organization. Now, restructuring costs can only be provided for if the entity is going to, or if the entity has a detailed plan. So there has to be a detailed plan about the restructuring, and then the restructuring has been communicated to potentially affected stakeholders. So for instance, if some people are going to be losing their job, we've informed them. If we are going to be uh, we will stop rendering or buying goods from suppliers, we've informed them about it. If that is the case, then we provide for restructuring costs. So when it comes to the various circumstances under which provisions could also be treated, this is one of the things, or these are some of the events that we can talk about. Then finally, about provision, then we will go to our question, is that when it comes to provisions, at the end of the day, provisions can be seen from two angles, and their treatments are different. We have what we call asset-related provision, and then non-asset-related provisions. Okay, so if the provision is related to an asset, then what is going to be happening is that it will be included in the initial cost of the assets. Okay, it will be included in the initial cost of the asset as part of the initial cost of the asset. So if the provision is an asset related provision, then it will be included in the initial cost of the asset. But if it is a non-asset related, then the initial recognition of the provision shall be in the P&L account. It will be recognized in the P&L account. Does it make sense? So that is how we deal with provision. So anytime you're dealing with provision, you need to ask yourself, is it asset related or not asset related? And that will impact on the way it will initially be recognized in the books of the entity. So for example, if there is issues about restructuring costs, I mean, that doesn't relate to any asset. So usually we're going to be writing that off in the P&L account. Then if there is issues about warranties, again, that will also be recognized in the P&L account. If there is issues about a legal case that has been brought against the firm, like an employee for unlawful dismissal, all these are non-asset related events. Hence, we will provide for them if they meet the recognition criteria just in the P&L account. But issues such as decommissioning cost, okay, issues such as environmental cost, okay, issues such as dismantling cost or landscaping cost, all of those kind of costs, these are asset related, hence we will include them in the initial cost of the asset. So basically, when we talk about IAS 37, provisions, contingent liabilities, and contingent assets, focusing on the first aspect, provisions, that is the crash costs and the principle that you need to understand. Let me know real quick any questions about the explanation, and then we're going to be taking a question in a moment. Let me know if the explanation makes sense. If you have any question for clarity, let's pick it up real quick, and then let's see how we can make that happen. So I see some comments coming in. Let's see. Kweku Ban, it's giving good vibes. I think that's an emoji there. Stephen Boache Donko said, good evening, sir. Good evening, Stephen. I hope that you're doing well, and welcome to the live stream. Give us a thumbs up on the video if you join. I see some of you guys jumping on the live stream, and remember to also share the video. Let us reach as many students as possible and assist a lot of students across the country, across the continent, and across the globe at large. It's very, very important, and that will help us a lot. Shiman Kanmo said, hi. Hello, Kanmo. I hope you're doing well. Maxwell Girasa said, hi, sir. Good evening. Hello, Maxwell. I hope that you're doing well in that case. Okay, so let me know if you have any questions, and then we're going to be taking that. So let's look at a question quickly here on the provision situation, and let's see what we're going to be having on how we deal with the treatment, Let's start with this simple illustration here for you to see how the initial recognition is done and the subsequent measurement is done. So you can take a snapshot of the question, as you can see on your screen there. This is coming in. This is coming from our question kit for financial reporting and corporate reporting, and this is specifically corporate reporting. It is about 237-page document of questions on the standards and all the topics that our students get when they enroll in our full course. So this question is coming from that kit, one of the questions under provision. So you can take a screenshot of it. For those of you who are learning corporate reporting or financial reporting under me or with us online, you can get access to the question in your kit under provisions. So let's look at the question real quick. Let's pick up a highlighter here. Okay. Let me bring in my pen. So a company started using an oil rig at a cost as follows. Construction and installation, $300 million. So the construction and installation is $300 million. The oil starts pumping at the early of the year. At this point, the company signs a license agreement with the government to dismantle the oil rig when the oil runs out, which is estimated to be 20 years. The cost of dismantling is estimated at 120 million, and the discount rate is 10%. The discount rate is 10%. So required, should the company provide for this? If yes, how should it be presented in the financial statement? So if you look at this question carefully, the question we need to ask ourselves is, has the recognition criteria been met? Rot. So if you look at the R, reliably estimation of the amount. Yes, the amounts to be paid has been reliably estimated to be 120 million in 20 years. So it makes sense we've met the R criteria. O, is there a present obligation? Yes, there is a present obligation. How? Because of the contract that we sign with the government, the license agreement with the government. So the license agreement with the government brings in an obligation that the entity must fulfill. And then T, definitely because of the contract agreement, the entity would have to pay for this dismantling cost in 20 years' time. So yes, the recognition criteria for provision has been met in this question, so we have to provide for it. But the question then is, how do we provide for it? So let's look at the initial recognition of the provision. Initial recognition. So when it comes to initial recognition, we need to ask ourselves, is this an asset-related provision or a non-asset-related provision in that case? Now, if we look at the question carefully, we realize that it relates to an oil rig, okay? So since it relates to an oil rig, it means that it is an asset-related provision. For that reason, the initial amount will be included in the initial cost of the asset. And then again, you realize that this is going to be paid in 20 years' time. The $120 million is going to be paid in 20 years' time. And so we need to discount it into present terms. So we're going to be calculating the present value of the dismantling cost. So the present value of the dismantling cost will simply be the future value times 1 over 1 plus R exponent n, which is going to be the discount factor. So we bring it up 120 million. Maybe let's tell the examiner that we want to work 3 zeros up. Is that possible? Yeah. We tell the examiner we like to work 3 zeros up so that 120 million will be 120,000 times the cost 1 plus 0.1 exponent 20. Exponent 20 because we're going to be making this payment in 20 years time. And remember, the entity entered into contract at the beginning of the year. So let's punch this out. I don't have my Casio calculator here, so you're going to help me out on the live stream in that case so that we can get some absolute figures in there. So please punch that out for me real quick. Give me probably we can just have the final answer if that's possible there, because today the calculator I didn't bring my Casio. So this is 1.1. 1.1. Is it possible I can? Someone should provide me with an answer. Probably. Okay, so let me see. 1.1 bracket close exponent 20. Okay. Multiply by 120,000. I'm getting something like 807 300,000. So 807,300 US dollars. You can confirm that for me real quick. Okay. Chibueke Okafor has given us the discount factor. So when you multiply, what do we have? Are you getting the same figure that I got? Let's confirm that real quick. Let's confirm that real quick. Let's confirm that real quick. So that is the present value of the dismantling cost. And so since it is an asset related provisions, the double entry is going to be that we will debit property, plant, and equipment. Okay, we include it in the property, plant, and equipment, and then we credit provisions. So that will be the initial recognition of our provision, the initial recognition of our provision. So let's get the initial cost of the oil rig. So the initial cost of the rig will be as follows. We get a cost of installation, construction and installation cost. Let's bring that up. Construction and installation cost. Construction and installation. And that is going to be, hey, you are getting 17. So it means I'm wrong. Okay, oh, I don't have my Julius Alajete said, I don't have my calculator here, but the discount amounts cannot be more than the fair value. That's very true. That's very true. Okay, I'm gonna write cheapest point 17,837. We're gonna stick with that. I think that would be a bit reasonable. So 300,000. And then we bring in the provisions for the dismantling cost. And that is going to be 17,837. So we add that up. And that gives us the initial cost. So that's 317,837. So that will be the initial cost of the oil rig. Does it make sense? That'll be the initial cost of the oil rig. So once we have the initial cost of the oil rig like this, what we're going to do is that we go to the subsequent measurement. Remember, the initial measurement is debit, PPE, credit, provisions. That is the initial recognition. So let's go to subsequent measurement. So on subsequent measurement, we would depreciate the oil rig over the economic useful life of the assets, and then we will unwind the provision for the annual charge. So we charge depreciation on the oil rig, and it is early of the year. We are just preparing for the first year, so that's going to be somewhere around 317,837 divided by 20 years. So let's get our answer coming up there. 317,837 divided by 20. I'm getting 15,892 as the depreciation for the year. Then we will get a carrying amount at the end of the year. So the carrying amount will be 317,837 minus 15,892. So let's get a figure. We got 317,897 minus 15,892. Please confirm these figures for us as well. So this is the carrying amount of the asset that is going to go to the statement of financial position. This depreciation goes to the P&L, okay? Then this carrying amount goes to the statement of financial position, all right? Goes to the statement of financial position. So that is it about the oil rig on subsequent measurement, the oil rig on subsequent measurement. But then what do we do to the provisions? On subsequent measurement, we unwind the provisions. So if you want, we could put this here as oil rig. Maybe we could decide to number our workings so that it makes sense. This will be workings 1. This will be workings 2. Workings 3. Then we'll do workings 4. That is the unwinding of the provisions in that case. Chika is saying that 301,945. How are you getting that? 317,837 minus 15,892. 301,945. So arithmetically, I'm wrong. So let's look at the workings for. That will be the unwinding of the provisions. Now, the unwinding of the provision is simply the annual charge, okay, which will be going into P&L accounts and as part of the cost of the entity. And this is about financing. Yes, Kano, we've done the correction on that. So as part of our issue in relation to the financing, so the finance cost will be the unwinding. So we bring the present value, which is 17,837, multiply it by the discount factor given to us in the question was 10%, if you remember. So this is what will be charged every year. Every year. So that's going to be 17,837 1,784 approximately, if we are working to the nearest 1,000. So 1,784. Now, what is the double entry for this 1,784? That is where we say you debit P&L and then you credit provisions. You debit P&L and then you credit provision. So at the end of the year, we need to get a carrying amount of the provision. Okay? So the carrying amount of the provision will be equal to the present value 17,837 plus the unwinding figure 1,784. That's how we get a carrying amount going into the statement of financial position. So 17,837 plus 1,784, and that's 19,621. So these are the various workings we do for this particular question. These are the various workings we do for this particular question. Any questions, please? Any questions for me real quick? Any questions? Any questions? Kanmo said, can you please go over the initial recognition? So with the initial recognition, what we mentioned there was that we discount the 120,000 into present terms. Okay, we discount the 120,000 into present terms. And the discount factor is going to be used using the cost of capital of the company. So once we calculate that, because this is an asset-related provision, we debit the property, plant, and equipment account. In other words, it will be included in the initial cost of the asset. Then we go and credit provision. So that is the initial recognition there. So Canmore, let me know if it makes sense for you. That was what you were looking at. Then another question. Okay. Vincent Buster said, good evening, Nhyira. I hope you are doing well. Yes, Vincent. I hope you are also doing well. Okafo Chibueke said, the unwinding of provision is somehow confusing. I don't know how confusing you are saying it is, but all we do is every year we will just take that or the year ended under consideration, we will take the present value we have and then multiply it by 10%. And the idea is that this is the amount of money we will be keeping every year, so that by the 20th year, we will be able to get the 120 million and pay for the dismantling and pay for the dismantling. That is basically what you need to understand there. Canmore said, thanks. Okay, you're welcome. And I see some of you guys joining us as well on YouTube. You are welcome. We are looking at IAS 37, provisions, contingent liabilities, and contingent assets. Remember to give us a thumbs up on the video when you are getting a value. It helps us a lot for the YouTube algorithm so that it can be pushed to reach a lot of students in that case. So let's go straight up into the financial statement, because these are all workings, all right? These are all working. So let's prepare the financial statement. So the statement of profit or loss. Remember, this is an extract, and we are preparing for the first year. So in the statement of profit or loss, what's going to be coming here includes the depreciation. And we did workings for that from at workings 3. and that is 15,892. Then we're going to be bringing in the finance cost. That's the unwinding of the provision in workings 4. Here, 1784. So that is what comes into the P&L account. Remember, this is an extract. We could decide to leave it like that, or we could put them in brackets. Any which way, we're going to be correct. Then we go to the statement of financial position. This is also an extract. We're working 3 zeros up. So we bring in the non-current assets. And under non-current assets, what we're going to have is that we're going to have the oil rig coming under property, plant, and equipment. The carrying amount from workings 3, if you remember, 301,945. 301,945. And then we will go to the liability segment. Then we will go under non-current liability. So we'll go under non-current liability segment in that case as well. So under non-current liability, because provisions of this nature is a non-current liability, and we could bring in here as just provisions, or if you want, we can say, or we can say dismantling cost. The carrying amount is 19,621 in that case. So that is how we answer this question relating to provision. Remember, this is asset-related provision, so we go about it this way. Any questions, please? Any questions? Any questions, please? Any questions? Comment is coming in from Bright. It said, good evening, sir. Can you please go over the whole workings for us? Whoa, the whole workings. Okay, so let's see what we can do on that real quick. So the first thing we do is to find the present value of the dismantling cost. We discount it into present terms using the cost of capital of the entity, which was given at 10%. Then we debit PPE with that figure and credit provisions with that figure as well, because that's the initial recognition in that case. Then as part of the initial cost of the asset, that is the oil rig, we will include the dismantling cost. So you add it back to it so that the initial cost of the asset becomes this particular figure, and that is going to be 317,837 in that case. So we put that up there for the period under consideration. Then on subsequent measurement, the oil rig will be depreciated over its life, which is the 20 years in that case. Then we arrive at the carrying amount of the oil rig. Then we unwind the provisions in that case. We unwind the provision. That is the very important aspect. Now, unwinding of the provision simply means you multiply the cost of the asset minus by the initially recognized amount in that case, so that you're going to be adding it up every year for the period. Then the carrying amount of that is that or the double entry for the unwinding, which is the finance cost, is that we debit P&L credit provisions in that case, and then the carrying amount will be equal to adding the initial recognized amount plus the annual provisions in there, So that is the workings. And in the financial statement, we bring the depreciation for the year, bring the finance costs, we get a carrying amount of the property, plant, and equipment, the oil rig, and then we get the non-current liability also coming in that case. All right. So Kanmo said, thanks, you are welcome. Idrisu Eba said, thank you, Nhyira. Always a pleasure, Idrisu. I enjoyed the class. Wow, that's awesome to hear. Laura Machaka said, so in year 2, when unwinding the provision, do I use a new carrying amount calculated, or I charge 784 yearly to the 20 years? It will be cumulative yearly like that for the 20 years. 17837.23. What are you talking about? What is the 17837.23? I think you're talking about the discounting factor also, arriving at the present value. If that's what you're talking about, yep. That's right. I think we got that. Yeah, so that is it about that. Any other questions? So questions of this nature, that is how we look at it. That's how we look at it in that case. Any other questions for me relating to this real quick? Any other questions for me relating to this real quick? So like I mentioned, if the provision relates to an asset, then we deal with it as an asset. But if the provision is a non-asset related, we just write it off in the P&L account. For instance, if I should show you another question here, let's look at another question here. I'm just going to show you this one. For those of you, I see a question coming up. Let me see if I can address that. If you are, that is more wine. Forgive me if I don't mention, I'm not able to pronounce your name well. If you are at end of the 20 years, maybe at year 19, then the provision will be non-current. I mean, yeah, that is correct. That is correct. It will become current liability in the 19th year, because when you go to you are going to be paying that in the 20th year. So in the 19th year, the cumulative amount will be coming in under current liability. That's correct. Isaac Zulu said, thank you, sir. I am watching from Lusaka, Zambia. All right. Thank you, Isaac, for joining us. Okay. So I was bringing up a question for you here. If you look at a question here, again, if you are having access to our question kits, because you are enrolled in our financial reporting or corporate reporting course, you get this in your book under page under the provisions. So look at this one also. HR Co has a financial year end 2018. It was notified that on July 2018, a former employee brought a legal claim for unfair dismissal. HR Co's legal team have said that it is probable that HR Co would lose the case, resulting in a payment of $495,000 on 30th June 2019. HR Co cost of capital is 10%, and a 1-year discount factor is also 10%. Calculate the amount to be recognized in the financial statement for the year ended 31st December 2018. So if you look at this particular question, it is not an asset related. So if you do the initial valuation, you get a present value. If we get a present value of the payment we are likely to make, that is $495,000 multiplied by the discount factor. The discount factor here is 0.9091. Is that it? Yeah. So you discount it. Let's see how much we get for this figure. So 495,000 times 0.9091. I'm getting around 450,004 or 450,005. So since this one is not asset related, what's going to happen is that we will debit P&L, okay, and then credit provisions. We debit P&L and credit provision with the initial recognition like this. Then on subsequent measurements, that is as of 31st December, remember, this was, the case was brought on 1st July 2018, and the year ended is 31st December. So if we are 31st December, we need to unwind. So the finance cost that is going to be coming in for this will be 450 times, 450,005 times 10% times 6/12. Because remember, from July to 31st December is only 6 months. So we're going to be charging only 6 months coming in there. So that's 450,005 times 10% times 6 divided by 12. Let's see. Times 10. Times 10%. I'm doing times 10. That's what I'm getting. Times 6 divided by 12. So I'm getting $22,500. So this $22,500 also will be taken to the P&L account like that. Because again, this provision is not asset related. So we debit P&L and then you credit provisions again. So it means the initial recognition and then the subsequent measurement figure all goes to the P&L. So in total, for the year ended 31st December, in the P&L account, the provision that will be recognized will be the 450,005 plus the 22,500. That is how we deal also with provisions if it is not an asset related provision. That is how we deal with provisions if it is not an asset related provision. So any questions about that also? Any questions about that? Real quick, any questions about that? Remember that if you are writing principles of taxation or advanced taxation, you can get access to our book on this. It is 120 cities. You can get access to it. It's available. Then also, if you are writing public sector accounting and finance, we have our new book also available that you can get access to. You can get it, the Kindle version, on Amazon, or buy it directly on Amazon, or better still, reach us out and then you'll be able to get access to this book as well and study for the exams. So any questions for me? This is the idea about provision. So when we talk about provisions generally, this is what we're talking about. So you should be able to know if it is asset related, this is how I'm going to be treating it. If it is not an asset related, everything is going to be going into the P&L account. And that is what you need to understand in that case. So let me know if there are any questions for me. Let me address them real quick. Philip Mbango, Pat Ahiable, Tano Benson, and then Kwabena Ajiman. Thank you for the thumbs up on Facebook. And also thanks for you guys on YouTube with a thumbs up on the video. It really helps us a lot and help to promote the channel so we can reach many other students across the continent because of the engagement on the video. Because of the engagement on the video. Right, so let's see, do I have any questions coming up? All right, so that is the idea about provisions. The issue about contingent liabilities, contingent assets are usually based on judgmental, or they are based on decisions by the organization. And if it is virtually certain that we are going to be making the payment, then we provide for it. If it is probable, then we're going to be disclosing it in the footnote. If it is not probable, it is not virtually certain, then probably we will also disclose it in the footnote in that case. And then if it is a remote, more or less like a foolish case, literally, then we are going to also be ignoring it at all in that case. Contingent asset, on the other hand, will be on the receiving end. So the one who is likely to make the payment will be dealing with contingent liability. Then the one who is likely to be receiving the payment will be dealing with contingent assets. And these are either recognized or disclosed in the footnote based on the certainty of whether the items will be received, or the income will be the money will be received or will be paid for the period under consideration. So Okafo said, thank you, Nhyira. Always a pleasure. Okafo, always a pleasure. So that is it about that. I'm going to be concluding around here today, and I'm going to come your way same time tomorrow as we continue with our discussion. Remember to follow us on Instagram, because details will be posted there. And on Instagram too, we have some videos there, and we'll be posting content there to help you to pass the examination. You can also check out our podcast. You can check the second link in the description of this video for our podcast, so that you can get the audio lectures and as well and listen to them whatever platform you are on. Just type Nhyira Premium wherever you get your podcast from. Type Nhyira Premium, because I will be there, because we have a wide distribution network for our podcast, so we will be everywhere for you. So that is it about that. Thank you very much for joining the live stream. It's always a pleasure coming your way. Remember that our lectures is still ongoing. We are in week 2 for the ICA November 2021 examination, and then we are really getting excited about it, and really getting into detail for financial reporting like this. Tomorrow, that is on Friday, tomorrow, we're going to be starting with accounting standards, and you're going to see how interesting these accounting standards are as we try to merge them, relate with them, connect them with each other, and solve broad questions in that case. Then for corporate reporting students, last week in session 1, we actually started with accounting standard IAS 2 and then IAS 16. On Saturday, we're going to be continuing with that as well in the corporate reporting class, and it's really getting interesting. So if you want to join us, it's 390 Ghana cedis per paper. You can check the first link in the description to this video and enroll in the full course online. Get access to our ebooks, our question kits. Join us on the live stream on Zoom sessions as well. Then have me to assist you, hold your hands, and give you the blueprints that you need in order for you to prepare well for the examination and, most importantly, pass the exams. Lukman Jackman said, thanks, Nhyira. See you in the AFR class tomorrow. Okay, I'll see you in the AFR class. Kanmo said, will upload this video? I don't understand. This video will be available on YouTube though, but if that is what you're asking, it will definitely be available on YouTube. To definitely be available on YouTube. Right, so that is it about that. Thank you very much for joining the stream. It's always a pleasure. You guys, I really like and love to meet you guys and share my thought with you. So, Kanmo, Laura, Cassie, Steven, Maxwell, Okafor, who else? We have Vincent, Bright, Idrisu, Mawan, Isaac, Charlie, everybody. Thank you very much. It's always a pleasure. I'll catch you same time tomorrow, 4:30 p.m. GMT, as we continue with our discussion. Remember that the objective of these sessions is to enable you to understand the basic principles underlining these standards, and most importantly, be able to solve questions relating to the standards. You will realize that in the question we solved today, even though we were looking at IAS 37 provisions, contingent liabilities, contingent assets, IAS 16 was in town in arriving at the initial cost of the assets. So like I keep on saying all the time, do not learn the accounting standards in isolation, because most of the accounting standards are related to the other. And that is what we want to do on these live streams, so that we provide you with that level of clarity that you need to pass the exams. In return, all we want you guys to do is to make sure you stay connected, subscribe to the channel, and share the video with your friends, your colleagues, and the people who you think will be interested in content like this, so that we can widen our scope of reach and help a lot of people across the continent, across the globe, and everywhere that they can find. And together, we can make the world a better place. Because if you become successful, I am successful, the burden on each of us will be reduced. But if you are the only person who is successful, then your burden actually goes up in that case. It is for this purpose why we have this platform and we create these content, so we can assist you guys so you can become successful. So check out our playlist on accounting standard series, and you'll get a lot of videos on all the standards, a number of the standards in that case. And if you are interested also, you can register to join us and learn directly under my mentorship on NhyiraPremium.com. So thank you very much, and I'll catch you same time tomorrow as we continue. Charity Labi said, thanks, Nhyira. God bless you. Always a pleasure. God bless you too, Charity. And thank you for joining us. So I'll catch you same time tomorrow, 4:30 p.m. GMT. Make sure you stay safe and you stay blessed. Remember, subscribe to the channel and click the bell notification icon. That way, when I go live, YouTube will send you directly the notification. So if you don't want to miss any of our live stream, any of our uploads, subscribe and click the bell notification icon. Once I go live or we release new content, YouTube will send that to you directly, and then you'll be able to follow up so you don't mix anything in that case. So that is what you need to understand about that, and I'll catch you same time tomorrow. Bye-bye.